Welcome back to Primary Source China Investment. Peng Guo and I are here for show W5. And this week, JP Morgan put out another 81-page slide on China, and we thought we'd break it down to the 13 most important and discuss some of the macro and micro happenings on the mainland. So let's do this in a very organized way. So this first screen that we're looking at is not only the savings rate, but the household wealth by asset type, which is this screen here. Of course, China has a huge savings rate, right? You see it there, 35% compared to some other countries. But the second point I think is instructive. China has massive holdings in property and savings, right? So 59% and 23% versus some of these other Japan, Australia, Taiwan, and the US. You see the US, the wealth in property is actually tied with the lowest with Taiwan, which is interesting. These two slides are related because not only do Chinese people hold a lot of their assets in housing, but they also have very expensive housing. You look at this chart here, you see Shanghai, Guangzhou, even Hong Kong, Shenzhen, Beijing, all very expensive. You know, New York gets a rap and San Francisco gets a rap, but they look absolutely affordable compared to some of these Chinese companies.
Surprisingly, New York is more affordable.
Yeah, that's shocking to a lot of people, but that's the reality. Then we go to this chart, which is the demographics trends, because all of this, I don't want to say all of it relates back to property, but property is a leading factor here. You have a number of things happening simultaneously. You have very expensive real estate. You have a declining total population, and you have a birth rate decline and a death rate increase. So this is like, I don't know, if I was a chartist, I would probably come up with a fancy name for this, but this is probably a doomsday scenario for the property market. So something has to fundamentally change in the property market. So the next slide here is on the capital market opening to foreign investment. And this has been a long trend, conversation, talking point. But the reality is foreign investors behave rationally. It doesn't matter what the policy really is if returns are hard to come by. And you see that investors are acting rationally. You see this last period, the equity holdings since 2022 have basically fallen off. That's also coincided with a decline in the market as well. You see the bond holdings had fallen off really hard because yields in other markets have improved, you know, rising interest rates, and yields on the mainland have actually stayed steady or declined. Another reason is definitely the press, right? There's been a number of bad headlines coming out of China as a slow and steady drip for many, many months, maybe even years at this point. And you can see in this chart right here, you have an unfavorable rating, which is an all-time high of US sentiment towards China. And there has been a constant drip of, are companies relocating out of China? Are they leaving? And it is showing up in the data here.
I would like to say, firstly, all those charts and the main points is already recognized by the market. I bet that probably for at least a year. So people already understand what's the problem, what caused the problem. Right now, they're just working on two things. If there are any solutions to solve the problem, or if any way to reduce the risk. So I think for the China real estate market, everybody knows that. Right now, it seems like firstly, it's still not get affected to the entire financial system, which is a good sign. So all those signals already show the bottom of the China equity market. Obviously, the current bottom definitely today is December 9th. I can be highly confident to say this is a current bottom for the China equity market. So overall, I think China is still in the recovery process. So is that a recovery back to the previous? Most of the people may not think about that. But at least they can try to recovery to most people could be acceptable level. So I think that could be at least in the next couple of quarters.
Well, we have a couple of slides on that, and let's get to that. There are two slides here that talk a little bit about that. So if you look at the slide on the consumer income and wealth effect, you see the CSI 300 has been declining, and the income confidence has gone with that, and the residential pricing property index, all of that has been declining. So like you say, investors know this. This is not new information. This data is all maybe backward looking. The point we're trying to emphasize here is, have we reached a bottom? Are we in the process of bottoming? And we're not going to bottom until consumers are willing to consume and consumers get their confidence back. And if you look at this chart right here, you have a huge drop off in consumer. It looks like, it bottomed, but we've been at a bottom for maybe 2 years. We've been at a bottom. So, that process does take time, and it's a good thing. And as soon as consumers' willingness to consume comes back, consumers' income gets stabilized or seen as improving, then you're going to see that turnaround that Peng was talking about.
Yes. I think this is a lot of the bad news in the past 12 months or
Absolutely.
in the past 2, 3, or 4 years. Most of them is already at risk. It already get released. It's already reached the bottom.
That brings us to the next point, which is the FX rate, because interest rates play a big part, but so does the renminbi US dollar. And if we look here,
oh yeah, the exchange is another hot topic. So
yeah,
people talk about the exchange. It affect everything.
Yeah, and you see volatilities come back. I mean, it was a lot of stability for a while. I mean, this chart is a 10-year chart basically, but if you look since 2022, the last 2 years, renminbi has depreciated a lot. I mean, 6.4 to basically 7.4. That's a huge move. We've talked about during this period of decline, there's been a few sectors that have outperformed and a few companies in those sectors that have outperformed because they are closely tied with Beijing. So if you look at the SOE as part of the CSI 300, energy, communication services, and utilities, these are 3 indices, 3 sectors that have done very well during the last 18, 24 months vis-a-vis the overall index. And, those are 100% SOE owned. The regulation, again, another point about regulation, it's instructive to see how much changes in regulations. And I've talked about this a lot. Every time there's a regulatory change, that means the cost of compliance goes up because it's very, very expensive to be in compliance. And this has not necessarily led to better performance. It's led to more regulations or changing in regulations, but hasn't led to an uptick in the equity market.
Oh, that's definitely true. All the compliance cost so is from the political reason as well as from the increase the entire the financial industry's cost.
We did a show a couple of weeks ago where China may have gone from the worst possible investment to a value play. I just throw this up here. This is the MSCI China forward PE ratio. Again, this goes back to 2003. You can see where we are now. Somewhere around 9.5 times forward earnings. We've been here before. We've been here, for half a decade before. So it may look cheap, but it could stay cheap. This is one of my favorite charts. It's very busy, but I really like to look at these kind of sectors. Getting your asset allocation right is the key to getting returns correct. So if you look at, 2018 was a wash. I mean, every industry was down. But again, utilities, which is 100% SOE owned, had huge outperformance relative to the overall index. But you see there's a lot of purple at the top, which is energy. And you see there's a lot of green, consumer staples, at the top. So these are kind of sectors to be looking at.
I would like to see this is the China efforts on the clean energy to make the energy sector remove from the top one.
Yeah. Last slide I wanted to put up were these bond yields, because this is a reason why foreign investors are maybe reticent to buy China fixed income right now, because you see here, China fixed income, this is corporate and government. This is like an aggregate. So you're talking 2.5, and in the US, what are we talking? 4.5. So that's a huge pickup, and you don't have the FX volatility as well. So China is actually the only lower yielding place is Japan, and even Germany has surpassed China in terms of yield. So you're looking at a difficult fixed income market. Although I've always said investors allocating to China should always buy a little bit of China fixed income. Any thoughts on that, Peng Guo?
That's definitely true. So we just review the performance. Looks like the treasury bond. We don't work on the corporate bond. So treasury bond looks like a pretty good. At least reduce a lot of the risk in the market. So right now it's really the risk off period. The bond is first choice.
And that's
at least
why
you don't lose the money.
Yeah, you don't lose money. The other thing is we're going to be looking for that change in sentiment. I think that's going to be the driver for the next leg up. We may have bottomed, but we could be bottomed for a while. So with that, we're going to leave it at show W5. Thanks for tuning in, and we'll see you next week.
Thank you.